Look, it would be great for us to make a couple hundred or a couple $1,000s a month flipping sports cards, but let's be honest, sports card investing has never been the path to financial freedom. On the flip side, it is said that over 90% of millionaires have accumulated their wealth from real estate since the 1800s. And fortunately for us in the sports card world, there are a lot of similarities between investing in real estate and investing in sports cards. In this video, I'll share with you the most powerful and proven real estate investing principles that my mentors taught me back in Tampa about 10 years ago that allowed them to retire in their mid-30s and travel the world with their kids. By the end of this video, you'll not only be a more savvy sports card investor, but you'll be a better real estate investor as well. Welcome back. Now let's get to work. It all started when I was 19 years old and I was a sophomore at USF in Tampa. Big shout out to USF for taking all my money and giving me a worthless degree. Don't worry, I'm not bitter if you can't tell. But I was in college and I got involved with a multi-level marketing company known as Quickstar. Quickstar was a nice word for Amway online. Long story short, I did not pan out becoming a successful Amway distributor, though I learned a ton. And that's where I really opened my mind to personal development as well as personal finance, because they gave me books like Rich Dad Poor Dad, Cash Flow Quadrant, and all these others, things that I never learned in high school and I certainly didn't learn in college. Fast forward a few years and my mind is now open to bigger possibilities. I know that I don't just have to get a college degree, work for 40 years and retire. There are people out there that actually save money, put it towards real estate, leverage responsibly, and retire at younger ages, like 40 and 50. And it wasn't until I had my internship with a couple named Daryl and Jennifer Williams down in South Tampa did I really see how practical real estate investing can be to retire early and just live an amazing life. Over my 6 months interning with Daryl and Jennifer, I worked in their office and I'd go with them and see exactly how they would scour properties in the area and what their parameters were and how they thought, which is huge. And it's what's really helped me in sports cards as well as the other real estate investments I've been making. And the first thing that they always preached was the numbers have got to make sense. Back in 2010, real estate in Tampa was dirt cheap. The big recession had just happened and everyone had their houses foreclosed or there were short sales going on. So it was easy pickings back then. But regardless, there had to be a formula in place for determining what a good deal was. For their investment style, they were going for cash flow first, appreciation second. So in layman's terms, that pretty much means I want to buy a property for it to rent out for a certain amount, and that rent needs to cover all of my bills. And their rule of thumb, which is very common in the real estate world, is 1%. Meaning if you buy a house for $100,000, 1% of it is $1,000. That needs to be the monthly rent. And if that's the monthly rent, it'll usually cover all your bills, your mortgage, your taxes, your insurance, vacancy, a little bit for repairs, all that kind of stuff. Back then, you could easily get 1.33%, 1.5%, maybe even 2% if you get a steal. But the point is that it had to meet those numbers. It was never about the emotions. Now with cards, there is no cash flow just yet, unless someone gets really creative and decides to open a little rental studio where you could take a picture with a LeBron PSA 10 rookie for $10 or something like that. But regardless, in real estate, it's called comps. So just like cards, we want to know the value of a card based off of what it's sold for in the past. And the more recent the sale, the more accurate we can price the card. If it's 3 years ago, we don't know. Same thing in real estate. Now this is getting tougher and tougher as well because we're seeing a lot of record high prices, which means that there has not been a comparable sale in the past. But that's also where different tools like Card Ladder and multipliers really can help us determine what a future value will be. Regardless, on CompC, that's why I feel very good about buying cards that have hit that high price in the past, knowing that as people enter the hobby and that player becomes relevant again, there's a better chance of it going up to that versus assuming it'll hit a new high, record high price. The second thing Daryl and Jennifer taught me was to focus on basic 3-bedroom, 2-bathroom houses in a certain zip code. Now this is important because a 3-bedroom, 2-bathroom house attracts the right person, which is usually a family. They need the extra bedrooms. They want it in a nice school zone so you have a nice family there rather than a bunch of college kids that are going to destroy the place. Because they focus on basic homes that may have needed a bit of attention, that ensured that there wasn't going to be a bidding war between them and people wanting to buy retail, like first-time homeowners that were looking to move in and call it their dream house. Because that means that their emotions would take over and they would outbid the price of what it'd be worth for an investor like Daryl and Jennifer. Now, transferring that over to the card world, I see a 3-bedroom, 2-bathroom house kind of like a rookie card or a card that's very easy to liquidate because everyone can be drawn to it. A good school zone would be like having a good eye appeal, where it's nice to look at. It's something where a collector would be interested, not just a flipper. Because if you are buying an ugly card that you feel will go up in value only to another flipper, then you're now eliminating collectors that would look at the card for their own piece. So that means you're playing hot potato with another flipper. You're just hoping you're not the last person to hold the potato. Real quick, I'd like to give a shout out to Chad, Yoav from Israel, Side Stacks, Scott Sign, Mark Cummings, Dom, and Paul the person. As long as you're not Paul Pierce, I will shout you out. Guys, thanks so much for the engagement. Now let's jump into the video. The third principle Daryl and Jennifer taught me was that they only competed with other investors. They did not compete with speculators or homeowners. And that's because speculators will always pump up the price, so will homeowners that have their emotions involved. Now, we kind of covered this in the past, but one of the biggest differences is that because they would pay cash and because they would deal with banks, they would be dealing with homes that were really ugly, that couldn't even get the necessary loans in order to pass inspection. Like, you couldn't get an FHA loan on a fixer-upper because it'd be so destroyed that it would never be approved. What that means is they would be able to swoop in and only compete with other savvy investors that would only have a certain limit at what they would pay, because they know that they would run the numbers and they would have to make a profit. If not, they would move on. Same thing in the card world. I've got to make sure that I'm competing with other investors on the purchase side, because if I'm competing with a speculator will always outbid me. If I'm competing with a collector that really wants that card, they'll always outbid me as well. The fourth lesson is this quote that I've said before on the station, and I will say it again in the future, which is, pigs get fed and hogs get slaughtered. It's completely natural for us to want to buy at the lowest price and sell at the absolute highest price. That's just how we think, that's how we operate, and that's what makes sense financially. This quote really stuck with me because I learned from them, very successful investors, that they don't go for the biggest profit or the lowest price all the time. In fact, they rarely do it. Instead, they develop a strategy that is going to serve them long term. And what a lot of investors do in real estate and everything else is they go for the biggest bang, the home run every single time. And that's a very dangerous strategy because it really only works for a little bit of time while the market is hot and while a lot of people are flooding in. But if you want to be a savvy investor, you're looking for that long-term strategy so that when the novelty wears off and people start looking at other opportunities, or people lose money for the first time and say, screw this sucks, and leave, they still have their strategy intact. And they're more of the tortoise that wins the race than the hare that gets burnt out and then just passes out down the track and gets eaten by a wolf. When you piece these lessons together, you get a better idea of why I invest the way I do. If you were to convert it over to New York real estate, everyone is focusing on the Tribeca penthouse condo that goes for $40 million, and everyone's just competing there. That'd be like the high-end rookie cards that just keep setting record prices, and that's what everyone wants because it's also sexy, it's cool, it's something you could show off, while I would rather look at the surrounding neighborhoods and the Lower East Side and East Village and see if there's deals there. That would be kind of like my Damian Lillard select rookie cards that I got for 12 to 15 bucks each, and certain low-end rookie cards and cards I know are like not as sexy and not as cool, but just less attention is going there. And then my other investing strategy, which is buying all the Tom Brady chromes and the Kobe Bryant finest and chromes and Topps base cards, is looking at it'd be like the equivalent of going out to Brooklyn 25 or 30 years ago, where people are talking about Brooklyn's going to be next, it's up and coming, but it hasn't reached that point yet. And that's more my mind space of, all right, if I'm buying cards at prices of what they were set at 2019 and 2018, 2017, knowing where the hobby's going, I believe that will go up without it really going down. It's like buying a huge lot in Brooklyn for $50,000 and it's like 3 acres. You know at some point it's going to go up. One extremely important lesson that Daryl and Jennifer taught me was how they knew to sell in 2006 versus hold on to their properties until 2008 when the big bubble burst and we had the Great Recession. If you've seen the movie The Big Short with Brad Pitt and Christian Bale, you get a good sense for how things were back in the early 2000s where loans were given out to everyone. And I even had a hairstylist in Tampa tell me that in 2007, he had 6 houses. 6 houses as a hairstylist. Like, that's how easy it was to get credit back then. So when I asked Daryl, I said, how in the world did you know to sell when you did versus hold on for a couple more years and have all your properties just go under? And he basically just summarized all the points there. And he said, look, when I ran the numbers, I couldn't buy more houses because the cash flow wasn't there. The property taxes were going through the roof. And you just look at the whole picture. It's taking a step back and seeing where the whole world is, the whole economy, and being able to say, all right, you know what? I can sell for a really good profit now, and I can move my money into something else that is low. That means he got out of real estate and started investing in other currency in other countries and different opportunities like that. So just always keep that in mind where when the sports card market gets too hot and things don't make sense anymore and pieces just aren't fitting, that it might be a good time to sell and put your money somewhere else. Just like Warren Buffett says, be fearful when everyone is greedy and greedy when everyone else is fearful. That's exactly how Jennifer and Daryl were with their real estate. They sold off and they were able to buy again in 2010, 2011 and build up an even bigger portfolio. For me, I'd rather sell months or even years early than one day too late because I do not want to lose money. I only want to make it, even if that means I'm leaving some on the table. Now, if you'd like to up your real estate investing IQ, 2 of the best books to start with are Rich Dad Poor Dad and Cash Flow Quadrant by Robert Kiyosaki. They are books I recommend to all my clients, and I've actually pulled out the most important and powerful principles from those books and put them into detailed notes that I am going to give to you. So if you're serious about it, just visit the comment section, check that link, click on it, and you get an instant download of detailed notes to both of those books. And that's because I really want you to be better with your finances and investing in and outside of the sports card world. Thanks so much for watching. Let me know what you took away in the comment section below. I hope you download those notes, and I'll see you in the next video.